The most expensive mistake in American inheritance isn't made by lawyers, and it isn't made by banks. It's made at kitchen tables by loving parents, following advice from a neighbor, a brother-in-law, or a guy at church who sounded sure of himself. The advice always sounds the same. Put the house in the kids' names now. Skip the courts. Keep it simple. And every year, families who follow it hand the IRS a tax bill of $30,000, $50,000, sometimes $80,000. A bill that would have been zero if they had done absolutely nothing at all. Read that again, because it's the strangest rule in the entire tax code. On the family home, doing nothing often beats doing something by tens of thousands of dollars. There is a reset switch buried in federal tax law that erases decades of taxable gains on your house at the moment of your death, legally, automatically, and completely. And adding your children to the deed while you're alive is one of the few ways to smash that switch before it fires. Tonight, how the reset works, the true costs that actually shrink an ordinary family's inheritance. Hint, it is not the estate tax you've heard about. The 3 well-meaning moves that quietly destroy it, and the free paperwork that protects the house, skips the courthouse, and keeps the reset intact, all at the same time. Every household passes its money on exactly once, with no rehearsal, and this channel exists so that yours gets it right the first time. Plain English rules, real dollar amounts, and the forms nobody mentions, every single week for people over 60. If that mission is worth something under your roof, subscribe before this one gets rolling. Start by clearing away the fog. Because inheritance costs are surrounded by more myth than any subject on this channel. Ask 10 seniors what will shrink what they leave behind, and 8 will say, the estate tax, the so-called death tax from 1,000 political ads. Here's the current reality. The federal estate tax now kicks in at roughly $15 million per person. $15 million. A married couple can pass down about $30 million before Washington's estate tax takes its first dollar. Unless your name is on a stadium, the federal death tax is not your problem. And any planning built around fearing it is planning for someone else's life. The costs that actually bite ordinary families come from 3 quieter directions. First, the courthouse, probate, the court process that freezes and supervises everything a person owned in their sole name, with its filing fees, publication costs, bond premiums, and attorney bills that routinely consume thousands of dollars and a year of time. And the family home is usually the single largest asset dragged through it. Second, a handful of states, 5 of them, Pennsylvania, New Jersey, Nebraska, Kentucky, and Maryland, still charge an inheritance tax collected directly from heirs, with rates that depend on the relationship. Spouses are exempt everywhere. Children are exempt or lightly taxed in most of these states, though Pennsylvania and Nebraska do reach them. Nieces, nephews, and friends pay the steep end. If you live in one of the 5, or your heirs do, that's a line item to know about. But third, and vastly bigger than both for most families, is the silent one. The capital gains tax on the family home. Nobody campaigns about it, no envelope announces it. And unlike the other 2, this is the cost your own family can accidentally multiply, because whether it lands at 0 or at $50,000 depends almost entirely on one decision: whether your children receive the house after your death or before it. To see why, you need the single most valuable concept in this entire video: the stepped-up basis. Stay with this for 2 minutes, because these 2 minutes are worth more than most paid financial consultations. Every asset you own carries an invisible number attached to it called its basis. Roughly what you paid for it, plus major improvements. When something sells, the IRS doesn't tax the sale price, it taxes the gain, sale price minus basis. Say you bought your house in 1982 for $65,000 and put in a $30,000 addition over the years. Your basis is about $95,000. If the house sells today for $410,000, the taxable gain is $315,000. 4 decades of appreciation, all of it in the crosshairs. Now here's the reset switch, under a provision of the Federal Tax Code, Section 1014, if you want to look it up. When a person dies, the basis of what they owned is stepped up to the fair market value on the date of death. The 1982 purchase price becomes irrelevant. The house your heirs receive carries a fresh basis of $410,000, today's value, and if they sell it for $410,000, the taxable gain is zero. 4 decades of appreciation, and the tax on all of it simply evaporates, not deferred, not reduced, erased by operation of law, because the asset passed at death. This is not a loophole for the wealthy. It applies to every taxpayer, on the modest ranch house exactly as on the mansion, and it is the default. You have to go out of your way to lose it. Why would Congress build such a generous switch into the code? Practicality, mostly, after a death, reconstructing what someone paid for assets across half a century. The house, the shares bought through a payroll plan in 1974, the land inherited from their parents, is often impossible. So the law simply resets the clock at death and moves on. Whatever the reason, take note of the breadth. The step-up is not a homeowner's rule. It covers stocks, mutual funds, land, the family cabin, nearly everything owned outright at death. Those 200 shares of an oil company your husband bought in the 70s, sitting on gains so old the paperwork is in a shoebox. Passed at death, the entire gain resets the same way the house does. The one big exception, 401ks and IRAs never get a step-up. They carry their own tax rules, which is one more reason each account type needs its own plan, which brings us to how families lose it. When you give an asset away during your lifetime, there is no step-up. A lifetime gift carries over your basis to the recipient. The technical term is carryover basis. Sign the house over to your daughter today, and she doesn't take it at today's value. She takes it at your 1982 number. All $315,000 of gain rides, along with the gift, sleeping quietly inside the deed, waiting for the day she sells. Same house, same daughter, same sale price. One path, inheritance, delivers it with the tax erased. The other path, the lifetime transfer everyone's neighbor recommends, delivers it with a tax bomb attached. And at the typical 15% federal capital gains rate, a $315,000 gain means a bill in the neighborhood of $47,000 before any state adds its share. That is the price of the kitchen table advice. Watch it happen to one household. Call her Pauline, 77, Youngstown, Ohio, widowed 9 years. She and her husband bought the house in 1979 for $52,000. By the time this story starts, it was worth around $310,000. Pauline's brother-in-law, a man who reads headlines and radiates certainty, warned her that the state will take the house and that probate would eat the kids alive. So Pauline did the loving, decisive thing. She had a quitclaim deed prepared and transferred the house outright to her daughter Renee, keeping nothing but a promise that she could live there for life. $60 in recording fees. Everyone slept better. 2 years later, Pauline passed. Renee, living 3 states away, sold the house for $312,000. And then the accountant called. Because the house had been a lifetime gift, Renee's basis wasn't $312,000. It was her parents' old basis, roughly $60,000 after accounting for improvements. Taxable gain, about $250,000. Federal capital gains bill, north of $37,000. Had Pauline simply kept the deed in her own name and let Renee inherit, even through probate, even with every court fee stacked on top, the basis would have stepped up to date of death value, and the tax would have rounded to zero. Renee's accountant walked her through it twice because she kept insisting there had to be a mistake. The house was her mother's. Her mother was gone. How could there be income? There wasn't a mistake. There was a gift, made with love, 2 years too early. The transfer meant to protect the family cost it more than probate, the inheritance tax, and every courthouse fee combined would have. And the quitclaim carried 2 stowaways nobody mentioned. First, a gift that size legally required filing a federal gift tax return. No tax owed at these amounts, but a filing obligation Pauline never knew existed. Second, and far more dangerous, had Pauline needed nursing home care within 5 years of signing that deed, the gift could have disqualified her from Medicaid assistance for a long stretch, because Medicaid looks back 5 years for exactly this kind of transfer and imposes a penalty period based on what was given away. One $60 deed, 3 separate traps, all avoidable by doing nothing. So pause the video mentally and run your own numbers. This takes 90 seconds and it will focus everything that follows. Write down what you paid for your home, add what you've spent on true improvements, and be generous but honest about what counts. The new roof, the addition, the remodeled kitchen, the replaced furnace and windows, the deck, the finished basement all count. The repainting, the mowing, and the repairs that merely kept things working don't. And that total is your rough basis. Dig for the old receipts eventually. But tonight an estimate serves. Now write today's honest value next to it. Any real estate site gets you close enough. The gap between those two numbers is the sleeping gain, the amount the step-up erases at your death, and the amount a lifetime transfer wires directly to the IRS instead. For most homeowners over 60, that gap is 6 figures. Keep it in front of you as we walk through the 3 ways families blow it up. Failure move number 1, the one this video is named for, putting the kids on the deed or handing them the house outright. You now understand the carryover basis bomb, but this move actually detonates on 3 fronts at once, so let's finish the demolition. Adding a child as co-owner of your home makes a share of your house legally theirs, today, while you're alive, which means your home is now exposed to their life. Their car accident lawsuit can reach it. Their divorce settlement can carve it. Their tax troubles can put a lien on it. You could find yourself negotiating with your son's creditors for permission to sell your own kitchen. It's the very trap families fall into when they add a child to a bank account. Except on a house, every number is bigger. Front 2 is the basis destruction you've now mastered. The gifted share, or the gifted whole, carries your ancient basis and drags the tax bomb into your child's future. And front 3 is the Medicaid look-back, the 5-year window during which any significant gift, and a house is the most visible gift there is, can trigger a penalty period that leaves a senior needing care with no house, no Medicaid, and no good options. 3 fronts, 1 signature, and a nuance worth 1 sentence, because it shows how thin the ice is. Transfers, structured with a formally retained life estate, real legal language in the deed itself, are treated differently on some of these fronts, which is exactly why this corner of law is where a 1-hour attorney consultation pays for itself many times over. Pauline's handshake, promise to keep living in the house, carried none of those protections. If the goal was protecting the family, the casual version of this move accomplishes the opposite 3 different ways. And the alternatives at the end of this video accomplish the actual goal for free. Failure move number 2. The opposite error, doing nothing at all and letting the courthouse take its cut. Because everything you just learned might tempt you to conclude, fine, I'll just die owning everything and the step-up fixes it. The step-up does fix the taxes. It does not fix probate. A house titled solely in your name, with no transfer mechanism attached, goes through the full court process. Months to a year or more of supervision, filing fees, publication costs, bond premiums, attorney bills, commonly totaling several % of the estate's value, plus a locked-up house that nobody can sell, rent, or sometimes even properly insure while the process grinds. And if you're in one of the 5 inheritance tax states, the heirs tax gets layered on top. The trick, and it's the whole payoff of this video, is that the law now gives you tools that thread the needle perfectly. You keep full ownership until your last breath, which preserves the step-up and keeps Medicaid and creditor issues clean, while the property transfers outside probate the moment you pass. Keep that combination in your head, step-up preserved, courthouse skipped, because it's the standard every option in the toolkit section has to meet. Failure move number 3, the sale that came too soon, or too late. Some seniors wanting to simplify things, sell the family home in their final years and park the cash. Understand what that does. A sale during life is a taxable event with no step-up. The gain wakes up. Federal law softens it with the home sale exclusion. A single filer can wipe out up to $250,000 of gain on a primary residence, a married couple up to $500,000. And for many households, that's enough. But for a long-held home in a market that's run hot for 40 years, the gain can blow past those ceilings, and every dollar above the ceiling is taxed. Dollars that would have been erased entirely had the house passed at death. And inside this trap hides a cruel sub-trap built specifically for widows and widowers. While both spouses are alive, the couple's exclusion is $500,000. After one spouse dies, the survivor generally keeps the full $500,000 exclusion only if the home sells within 2 years of the death. After that window closes, the survivor is a single filer with a $250,000 ceiling, half the shield, gone on an anniversary nobody marked on the calendar. There's a partial mercy. At the first spouse's death, the deceased's share of the home gets its own step-up, raising the survivor's basis, fully in community property states, by half in most others, which shrinks the gain before the exclusion is even applied. But the practical rule for a surviving spouse who intends to sell is simple and almost never spoken out loud. The 2-year mark after your spouse's death is a genuine tax deadline. Selling in year 1 versus year 3 can be a 5-figure difference on the identical house. No one at the title company will mention it. Now you know it. Before the toolkit, one resource: the exemptions, the fee waivers, the refunds, rebates, and protection. Forms that go unclaimed year after year, in every state, simply because nobody tells seniors they exist. All of it has been gathered into one plain English guide, the Senior Money Protection Manual. You look up your state, you see what you're owed, you follow the steps. No jargon, no hunting through government websites. The link is in the pinned comment, the first comment under this video. One tap gets you the whole thing. Don't wander off yet, though. The section coming up is the free paperwork this entire video has been building toward. How to skip probate on the house without touching the step-up in most states for the cost of a recording fee. Here is the toolkit. The ways to pass the home and the rest of the estate that keep both promises. Courthouse skipped. Reset switch intact. Tool number 1, the headliner. The transfer on death deed. Roughly 30 states plus the District of Columbia now let a homeowner record a simple deed that names who receives the property at death and does absolutely nothing before then. Think of it as the house-sized version of a payable on death form on a bank account because it runs on the same beautiful logic. You sign it, notarize it, record it at the county for a modest fee, often somewhere between a few dollars and $100 or so. While you live, you remain the full owner. You can sell the house, mortgage it, rent it, change your mind, and revoke the deed with a new filing. The named beneficiary has 0 rights, 0 ownership, 0 ability to interfere, and their creditors can't touch your home. At your death, the property passes directly to the person named outside probate by presenting a death certificate. And because it passed at death, the step-up applies in full. Courthouse skipped, reset intact, control never surrendered. It is, for the homeowners in the states that offer it, the single highest value piece of paper in this entire subject. A handful of states, Florida, Texas, Michigan among them, offer a cousin called the Enhanced Life Estate Deed, nicknamed the Ladybird Deed, which achieves the same trinity through slightly different machinery. And this is genuinely state-by-state law. The availability, the form, the witnessing rules all vary. So the first question to ask, of the county recorder's office, a local title company, or an attorney for one short consultation, is simply, does my state allow a transfer on death deed, and what does it require? One question. It may be worth more than everything else you do this year. Tool number 2, the beneficiary sweep, finishing the job across everything else you own. The house is the biggest asset, not the only one. Bank accounts take payable on death designations. Investment accounts take transfer on death registrations. Retirement accounts run on their beneficiary forms. Every one of them free, and every one preserving exactly the direct transfer logic you now understand. 2 additions most people miss. Vehicles. A number of states let you put a transfer on death beneficiary directly on a car or truck title at the DMV, sparing your family the absurd ritual of probating a pickup. And savings bonds and similar holdings can carry co-owner or beneficiary registrations of their own. For paper bonds and the online treasury system alike, adding a beneficiary is a form, not a project. While you're sweeping, check the odd corners. The credit union account opened for a certificate special in 2011, the small brokerage account from a former employer's stock plan, the checking account that only exists to pay the cable bill. Orphan accounts without designations are precisely what drags an otherwise tidy estate into court over pocket change. The goal is an estate where every significant asset has a named landing spot, because an estate like that can pass with the courthouse barely involved. Tool number 3, the small estate shortcut for everything that slips through. Most states offer a simplified affidavit process for modest estates. The thresholds vary enormously, which lets families collect leftover odds and ends without full probate. If the house and the accounts have all been handled by tools 1 and 2, what remains often fits under these limits, meaning even the leftovers skip the long line. Tool number 4, mentioned honestly, the living trust. You'll hear it pitched, sometimes hard, at steak dinner seminars as the answer to everything. A revocable living trust genuinely does avoid probate, preserves the step-up, and adds real value for complicated situations. Blended families, property in multiple states, a beneficiary who shouldn't receive money all at once, privacy concerns. It also costs real money to set up properly, and only works if every asset is actually retitled into it. The step most people skip, which is how families end up paying for a trust and enduring probate anyway. For a straightforward estate, a house, some accounts, kids you trust, the free tools above deliver most of the same result for the price of a recording fee. The trust is a fine tool. It is not a mandatory one, whatever the seminar salesman implies. Now the checklist, 9 steps, and none of them requires wealth, just an afternoon and a phone. Step 1. Calculate your sleeping gain tonight exactly as you did mid-video. Purchase price, plus improvements versus today's value. That number is your motivation for the rest of the list. And dig out the old closing papers and receipts for improvements while you're at it, because your heirs will want that file someday even with the step-up. Step 2. If any well-meaning person has advised you to put the kids on the deed, stop and show them this video before signing anything, if you're merely considering it. The answer, for the overwhelming majority of families, is a flat no. Step 3. If you've already transferred the house to a child, don't panic and don't try to quietly reverse it with another quitclaim, because bouncing deeds around can compound the mess. This specific cleanup is the one moment in this video where a real estate or elder law attorney earns their fee. Options exist. Get the situation reviewed properly once. Step 4. Call your county recorder or a local title office and ask the golden question. Does this state offer a transfer on death deed or a ladybird deed, and what are the formalities? If yes, get it drafted, signed, notarized, and recorded. An unrecorded TOD deed in most states is worth nothing, and confirm the recording with your own eyes. Step 5. Name a backup on that deed if your state's form allows contingent beneficiaries, for a reason worth engraving somewhere. A sole beneficiary who dies before you sends the house right back into the probate line. Step 6. Run the beneficiary sweep, payable on death on every bank account, transfer on death on every brokerage account, current names on every retirement account and life insurance policy, and ask the DMV whether your state does beneficiary titles on vehicles. One afternoon, every form free. Step 7. If you live in, or your heirs live in, Pennsylvania, New Jersey, Nebraska, Kentucky, or Maryland, spend 20 minutes learning your state's inheritance tax brackets by relationship. Sometimes merely knowing the rules changes decisions. In these states, what a will leaves to a niece is taxed very differently than what it leaves to a daughter. Step 8. Surviving spouses planning to sell the home. Circle the 2-year anniversary of your spouse's death on a calendar as a genuine tax deadline, and get 1 hour with a tax professional before listing. Between the partial step-up you already received and the exclusion window, the timing of that one sale can swing tens of thousands of dollars. Step 9. If you move to another state, a common chapter after 70, put the TOD deed on the recheck list along with the driver's license, because these deeds are creatures of state law. The new state may honor different forms, require re-recording, or not offer the tool at all, and a deed that was bulletproof in one state can be an open question in the next. Same review if the state you're in adopts the deed for the first time. Legislatures add themselves to the list regularly. Step 10. Put the whole picture on one page for your family. The TOD deed's existence, where the basis file lives, which accounts have which beneficiaries. Because every tool in this video works silently, and silent tools only help families who know they exist. Remember where this started. The most expensive mistake in American inheritance is an act of love, performed at a kitchen table on a $60 deed. The tax code, for once in its existence, is on your family's side here. It stands ready to erase every dollar of gain your home has built across the decades, automatically, at no cost, the moment the house passes at your death. All it asks is that you not smash the switch early. Keep the deed in your name. Record the free paperwork that hands the house directly to your family. Sweep the beneficiaries, and let the strangest, kindest rule in the tax code do exactly what it was written to do. And tell one more person what you learned tonight, because the kitchen table advice spreads by word of mouth, and the correction has to travel the same road. The neighbor with the confident advice means well. The IRS thanks him every April. Your family deserves better than both, and now you know precisely how to deliver it. Subscribe, because next week another rule most seniors never hear about gets pulled into the daylight.